which, believe it or not, I have had a great challenge in trying to get the number of slides down. So I think I've got it down to about 35 slides, and I want to be very respectful of your time. Try and get through these as quickly but efficiently as possible, and hopefully give you a perspective that you might not have had going into this on US-China relations, and especially about how to best allocate your investments between the US and China. Quick outline for those of you who may not be familiar with this webinar platform. Depending on whether you're checking this on a phone or on a computer, you should notice a sidebar either on your right or somewhere where you should see options like chat and polls and the ability to raise your hand to speak. During the presentation, you should be able to go into the chat and submit any questions you may have. I will only check those questions at the end, and I will have a Q&A session at the end. If you want to go ahead and test the chat, you can please go ahead and type a Y, a hello, a hi there, just so that I know that you're hearing me and that you can go ahead and test that it works. No embarrassment in testing that it works. You do have the option to either send your chat to everybody or just privately to me. If you send it privately to me, I won't reveal your name. I'll just answer the question. There is also just one poll question there where I do want to find out what your preferred way of investing in the US or in China is, whether it's through mutual funds, ETFs, or other methods. So with all of that overview, let's go ahead and begin talking about investing in the US versus in China over the next 10 years. Now, first of all, as with all of my webinars, I find it very important to start it with this important disclaimer. Okay, good. And for those of you who may not have attended my webinars before, very quick introduction to me. My name is Tariq Dennison, a estate practitioner and a certified financial planner based here in Hong Kong. You could describe me as a multinational wealth manager, and that I run a US registered investment advisor firm registered in the US and regulated by the SEC, and a pure Type 9 licensed asset management firm based here in Hong Kong. Basically, I manage my clients' retirement plans all the way through the life cycle, up through wealth accumulation, through income generation. I've been in the markets for over 20 years now, working at a variety of investment banks. I have been fascinated with financial markets from a very, very young age, having a master's in financial engineering from the University of Berkeley, mid-career, graduated in 2004, and I'm a visiting professor of fixed income and alternative assets at ESSEC Business School in Singapore. You may also know my book, Invest Outside the Box, Understanding Different Asset Classes and Strategies, and there are several topics at which you will find me speaking around the interwebs, whether it be ETFs, quality income portfolios, and a lot of what I'm talking about lately are retirement plans and keeping those retirement plans durable in a low interest rate environment. So this presentation is especially for you if you believe that US-China relations will be an important part of the world order in the 2020s. And I can say broadly, if you believe it's somewhat comparable to US-Soviet relations in the second half of the last century. I actually believe it's even more important than that, and for reasons I hope will be made clear. Also, given that you can invest in both the US and Greater China, I'm assuming that you want to have a critical view of looking at investments on both major markets and deciding how to best diversify among those two markets, again, with an open mind and with a critical view of the numbers and what the investment opportunity is. I also want to make very, very clear that I am here to talk about investment ideas, finance, and economics. I'm really not here to talk about politics, although I cannot completely avoid it on some of the topics that we're going to be mentioning later. So a brief outline of what we'll be covering. First of all, I'm going to be providing a big picture of China's historic economic growth. Along that economic growth, I also want to show the past 3 decades of performance of investing in the Chinese market versus investing in the US market, and a pattern that I've repeated quite often that you could decide whether you think is going to repeat or not. I'm going to be talking a little bit about currencies, exchange rates, and interest rates and demographics, very important theme. And I'll also be taking a more detailed look at some individual US stocks versus Chinese stocks and sectors. We'll be getting to some of those at the very end. Now, first of all, I want to start with a few charts and a few even memes and pictures that I'm sure you've seen from some of my earlier presentations, different versions of it. This is a log chart, but it's a log chart because I want to show really how dramatic the shift has been within our lifetimes. The point of this chart is this is to show nominal gross domestic product, so this is not adjusted for purchasing power parity, showing that within many of our lifetimes, so even just going back to the 1980s, little in the 1970s, China was about as poor as India. And now it is very much on track to be about as wealthy as the United States, again, all within about half of a lifetime for many of us. I know that has become a bit of a cliche, but there are many people who seem to know these numbers, but don't really quite appreciate the full magnitude of how enormous of a shift this is. I don't really know of many other cases except, say, Singapore, where really a country has gone from dirt poor third world to one of the wealthiest within half of a person's lifetime, within a person's working lifetime. Now, what is a bit out of proportion, even though China has become a very significant part of the world economy, it has not become a significant part of most international investment portfolios. So the top chart here is what percentage of the world's GDP these different markets are, and these happen to be the 5 major markets that I've often referred to by the acronym JUICE. JUICE meaning Japan, the US, India, China, and the Euro area. The top shows what their percentages are of world GDP, with China and the Euro area being about the same in terms of size of economy, whereas right below it shows what are the relative weights in the FTSE All-World Stock Index. So even though the US is less than a quarter of the world economy, it represents 55% of the market-weighted stock portfolio. And even though Europe is about the same size as China's economy, it'll be more than twice as much weighted in your stock portfolios. Similarly, Japan will still contain more in a FTSE All-World or MSCI ACWI stock portfolio than the world's second largest market. In terms of market capitalization, I know this chart can be a little bit hard to read, but down at the bottom you can see what some of these numbers are. Again, to try and clean it up a little bit, I've left out India for this particular one, but I meant to show how China's market capitalization has surpassed Japan's and has even surpassed the entire Euro areas in terms of overall size. Now, you may remember all the way back in the late 1980s, Japan's market cap briefly surpassed the United States. That seems quite long ago, given how much the US market cap has increased since then. Now, this is just simply the value of all listed stocks. It may not be necessarily a true measure of economic value, but at least again tells you what is the world's second largest stock market, and I could come up with a similar chart of the world's second largest bond market. This is another chart that I recently posted on my website, which some of you may have seen, basically showing how the world has changed since 1987. So on the left, I mentioned earlier what the FTSE All-World Index was. I'm sorry, on the right is what the FTSE All-World Index is now, showing the US versus Euro area and other markets. Whereas on the left is what it looked like back in 1987. Back in 1987, the US and Japan had roughly equal weights in the world's market. Japan's GDP had briefly surpassed the US. The size of Japan's stock market had briefly surpassed the US's. And so it was roughly equal on a global stock portfolio. And the rest of the world together made up slightly less than either the US or Japan. This was back in 1997. Now, fast forward to today, Japan is now less than 8% of the FTSE All-World Index. The US is a little bit more than half, and you've got other slices in there as well. But again, as mentioned, the world's second largest economy is this yellow slice there with only 3%. I'm not saying again that China should be a third of anyone's portfolio, and even if it were, you'd have to worry about the similar sort of concentration risk you had with Japan. But what I'm very often pointing out is, given the US's valuation, does the US mean you have similar concentration risk, having so much inexpensive US equities versus in the rest of the world, whether in one Asian country or the dozen other countries that you might be investing in? That's why I really find it important to take a very critical look about your country allocation in your global investment portfolio. Now, again, talking a little bit about anachronisms and people's different perceptions. I've spoken with people who have never been to China. I've spoken with people who said, yeah, I visited it once in the 1980s. It took a Three Gorges Dam cruise, in the 90s or whatever the time might have been. And the problem is if you don't live here and if you don't visit different parts of the country regularly, it's hard to appreciate, again, the rate of change. I wouldn't be too surprised if very many people a little bit older than me still have this view, which is very similar to my first impression of Beijing when I first set foot in Beijing in 1996. Still more bicycles than cars. The cars were still very much dated, didn't look as nice or as modern as what you'd expect in the West. And of course, anyone who's been to any mainland city recently feels the energy, feels the modernity. I don't even have to explain how much it's changed. There are three memes that you might have seen me present in different webinars before, but this is one of them. This is one that's been circulating around the internet a lot, saying if you meet anybody who doesn't understand why China is so important, show them this picture. The top is Shanghai, I believe, around 1986, and the bottom is Shanghai within the past few years. You can see that swirling tower hasn't yet been completed. Of course, now it's been completed. And it just shows you, again, the rate of development there. And this, again, is just Shanghai. I've seen it in a dozen cities around the country. This is another meme that you've probably seen circulating around LinkedIn or a few other social media sites, showing how many metro stops Rio de Janeiro added in the 20 years from 1993 to 2013 versus Shanghai, who had no metro in 1993, and the extent of its metro in 2013. A few more have even been added since then. Meme number 3 is one that I also like to emphasize because next, I would say after ESG, investing in China is probably the topic in which I meet the second greatest amount of skepticism. And the reason that I like this particular one is the switch between what you might consider fact or what you might consider fake. I have lots of people that I speak to who don't believe China's numbers, whether it be on coronavirus cases or financials or economic data, 6% growth rates or what have you. And what I say is you may not necessarily have to take all those numbers literally, but you still have to take the overall picture quite seriously. Just because you have lower quality data doesn't mean that there's not opportunity there for someone willing to roll up their sleeves, take a little bit of risk, do a little bit of homework, and find out where the opportunity is, rather than, again, just buying the whole market cap weighted index. This next chart is the one you may have seen me just post about an hour and a half ago as well. And this is a fairly nerdy chart. It would be one that I'd have a hard time getting most people interested in, but it's hard for me to exaggerate how important this chart is. Because what this shows is it shows what is the energy intensity level, meaning what is the amount of energy that I need to use, that I need to burn in order to produce $1 of GDP. Now, in this case, this GDP dollar is inflation adjusted and it's corrected for purchasing power parity. So it's really meant to be for what a dollar could buy in goods and physical stuff, goods and services on a purchasing power basis in 2011. So adjusted for inflation and everything. All the way back in the early 1990s, China needed to burn 2.5 times the amount of energy that the US did in order to produce the same dollar of GDP. Now, that means a lot of different things. One is that it just wasn't as efficient an economy. It was a lot more wasteful, but it also, too, what's still true even today is that China is much more reliant on manufacturing, heavy industry, and a lot of very energy-intensive industries, which you would expect when you compare it to a very service-oriented economy like the United States. It probably shouldn't surprise anybody that PetroChina is a larger part of China's economy than, let's say, ExxonMobil is to the U.S. economies. And of course, it's a much more energy-intensive industry. And it requires more energy to generate $1 for PetroChina than it does, let's say, $1 for Alibaba or for Amazon. Now, if we look over time, we'll see that right now China's energy intensity has fallen dramatically, far more than the US's or India's. And right now, China uses less energy to produce $1 of GDP than the US did at the turn of the century. And again, for those who are environmentalists or those who are looking at just broadly the shift from manufacturing to services, this is another chart that the importance of cannot be emphasized enough. So again, I don't want to spend too much time on it, but I do want to bring it to your attention because I would bet for most of you watching this, you may not have seen this chart before or appreciated how important it is. Now, obviously, I said I don't want to talk too much about politics, but one of the timely news topics that I cannot avoid are about the trade war and really a little bit more broadly about the U.S. election. So when I was first brought this up, the main topic was simply the trade war. Since then, of course, we have the coronavirus, obviously political finger pointing, calling it the China virus, or recently you had a Democrat calling it the European virus for whatever reason. But the one thing that I will point out is that the U.S. has an election this year, whereas the one issue that I think both political parties can agree on is that if things aren't going well in the US, let's blame China for it. There are a few different statistics we can look at, but one, which again, there's going to be questions on the quality of the data, but I don't think there's any disputing that COVID-19 has hit the US far worse and far harder than it hit the Chinese economy overall. There's been a lot of criticism about how China handled it early on, didn't lock down the cities early enough, and initially was hoping it would go away. But no doubt, once they got serious on it, the number of active cases peaked in late February. By middle of March already, many people I was speaking to in mainland Chinese cities said they already considered COVID-19 behind them. And right now, if you look at WeChat, you look at different sources, you'll see people walking around mainland Chinese cities, restaurants. Many of them don't even have their masks on. And by comparison, the US is still worried about mail-in voting, worried about school reopening, about universities. It's still a major, major problem in the US. And as someone who would like to be proud of the US, I do find this somewhat embarrassing. Now, I can say there are, of course, many constitutional freedoms or ways that Americans do things that make it much harder for the US to have stopped the coronavirus in the same way that many Asian countries have. For example, over here, the degree of surveillance and contact tracing, let alone hand washing, mask wearing, sanitizing elevator buttons, are just completely different between the two countries. But this is one chart that I do not think you can separate from the fact that the US getting hit so bad from the coronavirus means that a very easy response is let's point the finger at China. And this has come in many, many different ways, from saying we're going to delist Chinese companies, we're going to ban pensions from investing. And just because that may be the politically expedient thing to do in an election year, I don't think that necessarily makes it the right thing to do. So that is probably the high point of politics in this presentation. Again, probably nothing that you haven't heard of before. So next section. I said I wanted to talk about 3 decades of stock returns of US stocks versus Chinese stocks. And for comparison, I'm going to throw in the EFI index, which is the Europe, Australasia, and Far East index. Now, first of all, I've been talking very broadly about Chinese stocks, but I like to bring up this chart to just say, when I talk about Chinese stocks, which ones am I talking about? Clearly, there's an alphabet soup of Chinese stock markets, because there's the domestic A shares listed in mainland China, traded in renminbi in Shanghai and Shenzhen. There are the H shares listed here in Hong Kong, traded in Hong Kong dollars. The B shares, which are a faded market, traded in US dollars in Shanghai, Hong Kong dollars in Shenzhen, not really so relevant anymore. Red chips, which are a certain type of Chinese company, mostly listed in Hong Kong, holding mainland Chinese assets. P chips, which tend to be incorporated in the BVI or Caymans or other offshore jurisdictions. Pure Hong Kong companies like AIA, which are incorporated in Hong Kong, but also listed here, often separated from mainland Chinese companies. HSBC, which is one single stock, technically incorporated in the UK, but most of their revenues come from Hong Kong. Taiwan, which is part of Greater China, but not included in many MSCI China indexes. The Chinese companies that are listed in the US, so that would be, for example, Baidu, Alibaba, and so forth like that, some of which have only recently gotten listings back here. And what you might sometimes hear of are called the S-chips, mainland Chinese companies that are listed on the Singapore exchange. I've written a few articles giving a bit of the tour and the overview of what all these different markets and subsegments are. But obviously, that's what keeps me busy, is going to each of these different levels of the market and finding where the opportunities are. So definitely ping me if you want to find out about any more of these. Back to the big picture, the comparison that I'm using is the MSCI China index. So if you caught on those lines, that was up towards the top, and it shows you what it included. It included pretty much mainland Chinese companies listed both onshore and offshore, increasingly both. And this first chart is looking at really the first decade that you could have made any decade in investment in the Chinese market at all. Really wasn't even possible until the early 1990s. I think Jim Rogers in his Investment Biker was talking about the story when he first went to Shanghai and first bought B shares, had to go to a counter, pay cash, had them on paper, had no interest in actually knowing what they quote for now because they're not for sale. He just wanted to buy and hold them forever. But the bad news, of course, is that if you bought the average Chinese stock back in 1992 and you held them through the end of the 1990s, your $100,000 would have been worth $40,000. It was generally a bad year because it was a new market. Financial quality hadn't really been established. One of the first stocks listed in the Hong Kong Exchange, as you may know, was Qingdao Beer. Qingdao remains one of my favorite cities in mainland China. So if you compare it to the US and ETFs indices, the 1990s was a good decade for US stocks. And towards the end, it was very much buoyed by stocks like Microsoft, America Online, Pets.com, eventually Amazon, which went public later on. Parts of the late 1990s definitely remind me of today. But there were other things too in the 1990s. The US had just ended the Cold War, had just started a great logistics boom. There were lots of things which the US was genuinely improving in the 1990s. Whereas the EFA index was really weighed down by the popping of the Japanese bubble. Japan, of course, had reached its peak in the late 1980s, and throughout the 1990s, it was really holding down what most people considered international, which was international developed markets. Now, if you move on to the following decade, the 2000s, it's a decade that many of us may remember for other themes. Just as we remember the 1990s for the introduction of the internet, the ending of the Cold War, we'll remember the 2000s for 9/11, for the rise of China, for China joining the WTO, and for a lot of other themes, which make it seem like a very, very different era. By the end of the 2000s, ExxonMobil was one of the largest and most profitable companies in the world. But what had happened over this decade was China had joined the WTO, and a lot of those stocks that had gotten beaten up in the 1990s had gotten beaten up a little bit too much. You'll see that from 1999 to 2001, they fell another 50%. But if you had bought them then, if you had bought them anytime between 2001 and 2002, it would have treated you far better. It would have been a much better performing investment than investing in either the US or in foreign markets. Now, I should also point out that throughout the 2000s, foreign markets, the EFA index outperformed the US as well. Some investors have actually said that the US market, investing in US stocks from 1999 to the end of 2009, was a lost decade. And that's what this chart shows. I tend to look at investments over much, much longer time horizons. And if you ask me, the next chart, as you can probably guess, will show a decade that looked a lot like the 1990s. And the question is, do you think the 2020s are going to be more of a repeat of the 90s, of the 2010s, or the 2000s? That's why I'm presenting these. And this is the chart that you're probably going to be more familiar with. This is the past 10 years. This one shows you that from 2009, what's almost annoying for any of us who've been international investors is that the US seems to have almost gone just straight up, just ticked, straight up year after year after year, whereas foreign markets have really kind of flaggered, gone sideways, traded range bound, really have not been able to keep up with the US. Now, over the past 5 years, a very large percentage of the performance of the S&P 500 has come from just the top 5 names, which we will see later. There's also been big divergence between growth and value, between large caps and small caps. Those are all things that we will look at later. But the theme that I'm really trying to highlight in these 3 decades charts is that the performance of the US versus international and international versus US does seem to go in cycles. And it's not too far off to say that those cycles are roughly every 10 years. And I have reasons certainly beyond this decade by decade cycle, but to believe that the US is probably going to be facing some headwinds over the next 10 years, no matter who wins the election this November, really just based on valuation and ultimately fundamentals relative to some of these foreign markets. One of the measures for relative valuation is something called the CAPE ratio. This was popularized by Professor Schiller, and CAPE just simply stands for cyclically adjusted price to earnings ratio. It means you take the price today, you divide it by the average earnings over the past 10 years. So whenever the CAPE ratio is high, it means that stocks are expensive. Whenever the CAPE ratio is low, it means that stocks are cheap. You can see that historically, one of the most expensive times for stocks was back in the 1999-2000 tech bubble. So right around here would have been the worst time to buy US stocks, especially. Hong Kong stocks, by comparison, weren't so expensive. Remember, Hong Kong was still recovering from the Asian financial crisis, that bubble that had popped in 1997 to 1998. So if you'd invested in Asia at that time, it might not have seemed so bad. Now, a little bit later on in the mid-2000s, that's where we saw the big China bubble up here. the Chinese A-share market specifically had run up even more than the Hong Kong market, then later collapsed and crashed. But really what I want to point your attention to is what the ratios are right now. Because whenever people are saying, oh my gosh, markets are so high, so expensive, I can't understand why they are this high, remember there's a difference between the US market and many, many other markets. The US markets are now trading at over 30 times the average earnings over the past 10 years. Now, this is CAPE ratio, not just regular PE. Whereas many other markets are quite a bit cheaper. Now, there's no general rule of thumb, but you could generally say that CAPE ratios under 20 are reasonable. CAPE ratios under 15 are somewhat cheap. CAPE ratios over 30 can be relatively expensive. And on my website, I have a chart showing what the following 10 years return has been on average as a function of CAPE ratio. And this is going all the way back to fairly old data. Now, it's not perfect. It's not saying just because markets are expensive now that they won't get more expensive, but it does tell you why I look at all of these different markets and I try and look at the ones that are relatively cheap compared to what their earnings power is and which ones have more upside than downside by comparison. Okay, so moving on, I also don't want to forget that even if, for whatever reason, you just want to stick to US listed stocks, not even just US listed stocks, but US companies specifically, that US companies themselves have very different levels of China exposure. So this, for example, is from Apple's most recent quarterly report. I actually did once work with a broker who once said that he doesn't buy any foreign stocks. If he wants to invest internationally, he just buys Coke and Caterpillar. The reason being that those were two companies that had large amounts of international sales. Now, the same exact thing with Apple. You can see here that Apple has a very large share of its sales overseas. Of course, it does sell a lot of iPhones in the US, but it also sells lots of iPhones in Europe, Greater China, Japan, and the rest of Asia Pacific. And you might have heard the story lately that if Apple was forced to remove WeChat from the Apple Store, it would instantly destroy about 20% of their global sales, because what use is an iPhone in mainland China if you can't run WeChat on it? WeChat is by far the most important app, and that's something that obviously you need to consider, even if you're just sticking to US companies. I don't have a good data source yet for individual companies' exposure to China in different markets without going to each individual quarterly and annual report. If you do have a data source like that, I'd definitely be interested in seeing it. But I do like looking at these individual reports and seeing how these different businesses break down. So something else to look at. That was a bit on stocks. We're going to be going back to stocks later, but I want to take some time now to look at currencies, interest rates, and demographics. So first of all, when I talk about currencies, I like to talk about which currencies are relatively undervalued or overvalued. You can sometimes look at the Big Mac index. This is just the PPP conversion factor, which is basically a way of trying to compare if I were to take a basket of goods, if I were to take a lunch, a telephone, a one-bedroom apartment rent, a different basket of goods, and I would try to compare them in a typical Chinese city versus a typical US city, would that mean that the renminbi is relatively overvalued or undervalued? And over here, at least what this is saying is it's saying that the renminbi is not as undervalued as it once was, but it's still relatively cheap as a currency. Now, this can mean a few different things. It can mean that China can afford to keep its interest rates higher. It can afford to have more inflation before the two come into parity. It can also mean that the renminbi is on a path to appreciate. It can really mean any of those things. Now, I want to include always one other currency by comparison, because if you've looked at my long-term currency charts, you'll know that the renminbi was a depreciator really until the early 1990s. The idea that the renminbi could trade sideways or even appreciate is a relatively new idea. By comparison, the Indian rupee had long been a depreciating currency. So the Indian rupee has been a currency which was cheap before, it's cheap now, and if you look at the exchange rate, it's just been getting cheaper. And that's because its interest rates have been higher, both real and nominal. So I want you to look at the renminbi as somewhere between the US dollar and the Indian rupee, and keep that in mind when you try and look at what currency risk is in a market like that. I definitely know people who are much more bearish on the renminbi than I am. My own view is I think we're probably going to see a slight degree of appreciation as the Federal Reserve keeps dumping dollars on the market and the US faces some inflation while China is able to maintain higher real interest rates. That's my own view, but we can debate that offline. One of the reasons for that view is interest rates. Now, for the longest time, renminbi interest rates have been higher than US interest rates for a number of reasons. But the part of this chart that I really, really want to highlight is this part right here at the end. And this is basically showing how interest rates responded to the COVID crash, to the pandemic's impact on markets back in March of this year. So pretty instantly, the Fed cut rates and the US bond market, the whole curve came down. People were talking about the US 10-year possibly going to zero, and it's still around 70 basis points. The 30-year US bond is still only yielding 1.3%. So US bond market has responded dramatically, and any US bond investor, pension funds, and so on have really felt the impact of this. You really can't miss it. The renminbi bond yields, on the other hand, bounced very, very quickly. Now, obviously, the renminbi bond market is not as open, is not as international, is not as widely traded. So there are many different ways of interpreting this. But one of the ways I interpret this is that the Chinese economy, the real economy, recovered much more quickly, and it's able to handle higher interest rates than the U.S. Economy is. We're going to see later that the purely demographic explanation of many emerging markets doesn't really hold when we're talking about China, and we'll see why in just a bit. When I talk about many emerging markets, I often talk about the advantage of having a younger population. Now we're going to see this is a bit of a mixed bag for China due to many, many years of the one-child policy. What this chart shows is it shows something called the age dependency ratio. It basically means what percentage, it's a sign of your working age population relative to the rest of your population. So you take the percentage of your population that's working age versus the percentage of your population that's under the age of 15 or over the age of 65. Those under 15 are considered dependents, and those over the age of 65 are considered retirees. And if you were purely cared about economics, you'd ideally want all of your population in that 15 to 65 range, young, productive, working, without people who are sitting on the sidelines and in theory not producing. I know I probably insulted some very hardworking 80-year-olds who might be listening to this call, but you know what I mean. I'm talking about classic working age population. Now, during the height of China's economic boom, that period where it went from being as poor as India to almost as rich as the United States, it benefited from the fact that it had fewer children. It had fewer people under the age of 15 to take care of. So you had the ability for a large working age population, many of whom were not married, or some of whom had only one child and were really able to support the workforce. You are going to see, obviously, the results of this later. Now, you see very, very recently, this is starting to turn up. And the real risk you have to look at is the risk that I sometimes say, China getting old before it gets rich. That dependency ratio crossing over the US before China's per capita GDP catches up with the US is a dangerous sign, and it is going to be one of the most important trends to watch over the next 20 years. The tell of that is really the overall population growth. As I mentioned with working age population, part of that didn't just have to do with number of people growing up. It had to do with the relative decline in the under 15s. Because of the one-child policy, which started in the 1970s, since the 1990s, China's population growth rate has been below that of the US. Now, that is, the largest emerging market has a population growing slower than the largest developed market. By some projections I've heard, by the middle of the next decade, China's population may even peak and even start declining. That is really quite a more significant demographic shift than I think many people have appreciated. And I think there are lots of ways of looking at demographics and investing, but these are just the main numbers that I want to put in front of you for that. You may have seen other charts that I've shown, which have showed that in general, the older a country's population, the lower its interest rates. The median Chinese is about to be as old as the median American, if not already, and soon the median Chinese is going to be even older than the median American. China's going to have more old people than it does than the US does, and that's, again, something to watch. So now I want to go back to the equity market and look at a few more specific numbers. And the first one I really want to look at side by side. On the left, I want to look at the S&P 500 compared with the MSCI China index. These are both from BlackRock iShares. These are comparing two of the largest tracked indexes that are used by allocators, by ETF investors, and so on. Now, there's a lot here, I know, but we can just compare on the left, PE ratio, price to book ratio. Broadly on the top line, we're showing how much more expensive the U.S. equity market is. If we want to look at standard deviation, as we've seen earlier, the Chinese market still is more volatile than the U.S. market for a number of reasons. But now if we look at the top names, we also notice what are called the FAMGA names: Facebook, Apple, Microsoft, Google, Amazon. Whereas we traditionally have the BAT-J names, the Baidu, Alibaba, Tencent, and JD, and one that I'm increasingly being asked to add, which is Meituan Dianping, an e-commerce name. All of these names, which we might consider China's tech giants, are labeled as consumer discretionary. And that's at the very top here where you see consumer discretionary, very much the Alibaba, and Meituan Dianping here. Now, you'd have to decide how well does that really compare with the Apple and Microsoft over here that are rated information technology. That's a little bit up to you on the sector's part. Usually what I worry about when I look at the China index is an overexposure to financials and insurance companies, which certainly are there. But really right now, you are looking at a more diverse index than you typically see in many emerging markets. So I'll leave that there, and you can look by comparison. I also want to show a few quick charts of some of those top names. And some of these are compared head to head. I know they're not exactly the same, but they'll give you some ideas. This first chart here just shows you the revenue, return on equity, and price to sales ratio of Amazon versus Alibaba. Again, this is if you were to try to compare them head to head. In terms of top line reported revenue, Amazon is still an overall larger company than Alibaba. That's at least, of course, as reported. In terms of profitability, they're comparable return on equity numbers, and valuation. What you see is that Alibaba is still more expensive on a price to sales ratio. So these, again, are all things for you to compare if you want to look at a growth at a reasonable price type of number. Next, if we want to look at Facebook versus Tencent, we see a much more comparable revenue growth track, and again, a trend of really steady over 20% return on equity rates. Unlike Alibaba versus Amazon, we see them having much more comparable price to sales ratio. It's not as though Tencent or Facebook, one is much more expensive than the other. And again, price to sales, some people may consider something at 10 times sales expensive or for a startup, but you really have to compare price to sales versus the margin and return on equity rates of a business. These are very, very, you all say, capital light and highly profitable companies. Last but not least on these comparisons, I want to compare Alphabet and Baidu, also known as Google versus Baidu. Much less of an apples to apples comparison because I've met many people who go to mainland China and say they wish they could use Google. I don't meet many people who go to the US and say, oh my gosh, I wish I could use Baidu instead of the other way around. Baidu still has a lot more catch up to do, even though it is the main search engine there. By the way, full disclosure, I do have long positions in all the Chinese names here, including Baidu, where we're running a covered call position right now. So Baidu is the smaller name. It used to be the more profitable name and less profitable now. But at least on a valuation basis, for a dominant search engine, Baidu is much, much cheaper than Google. And by the way, I don't even think Alphabet is that overpriced on its metrics. Second to last, I want to talk a little bit about the shock test because people are often talking about short-term performance, year-to-date, markets are up, this and that. I really like to look at fundamentals like revenues and earnings and so forth. But really, when I want to look at shock test, this chart is really meant to show how different the Chinese market has reacted versus the US market. So some people have said, oh, isn't it amazing that even though we've had all these lockdowns and pandemic, the S&P 500 is actually still up for the year? Yeah, in fact, it is. It's up 5%. The NASDAQ is up even more. But to show you how narrow that is, if you look at small stocks, U.S. small caps are still down almost 10% for the year. And if you look at Main Street U.S. businesses have been hit much, much harder than the large cap FAMGA names. But by comparison, if you look at the Chinese names, here I'm showing the MSCI China and MSCI China small cap. Both have recovered and are actually up for the year even more than the S&P 500. And I think that's a bit of a sign of resilience, but also revaluation and a few other metrics that we should be looking at. Especially good sign that you see that strength in small caps. And last but not least, I mentioned cap size, decades, and a few different things. I want to show sector by sector, and I don't want to take too much time going over each individual sector, but the way that I've sorted it is I've shown each sector one at a time. Oops, sorry, I just realized I kept that there. So showing each sector one at a time, so you can compare communication services, you can compare staples, you can compare financials, for example. And I put next to each other sales growth versus price to sales, earnings growth versus price to earnings. So you can see which sectors have growth and the growth is expensive, or the growth is relatively cheap. I like to do these in a heat map format, so you can pretty much see at a glance where you see lots of greens, you mean you have lots of growth at a relatively cheap price. And when you see lots of yellows and reds, it means you don't have quite as much growth, but it's very, very expensive. So those are overall the metrics that, again, I want to keep in mind and say that even though it's easy to kind of look at the averages and say, oh, it's so expensive, when you look down at sector by sector, or large cap versus small cap, or especially down at the individual company level, there's huge dispersion by which companies are more profitable than others, growing faster than others, and cheaper or higher or lower yielding than others. And that, of course, is probably a little bit obvious, but I just wanted to make sure that it was all clear and we had it there. So thanks again for making it to the end. I know there were a lot of slides there, and I really wanted to try to keep it down to 1 minute per slide. But if there's interest, I could be here for a few more minutes and answer a few quick questions, either here or offline. Let me know. And just a reminder as well, if you have the ability to go to the polls section, if you either see that on the side or if you see that on the menu to the top, you can go there and it will just ask you one question: what is your preferred instrument for investing in these markets? Okay, so for now, I don't see any live questions on the chat or any hands raised, but I'm going to go ahead and save this video. You should receive a replay link within 24 hours, and of course that will include my contact information and a way for you to reply to me in case you want to ask me any questions directly or online. I try and go ahead and send these quite regularly. I just got a very quick question. I'm just going to quickly address this. How much do you think the threat of Chinese stocks having to delist will have? And now I don't know if the question is so much, is it much of a risk factor or what exact impact it'll have? What we've already started seeing is that some of those Chinese companies have already started to have secondary listings or look at listing on exchanges like Hong Kong. Hong Kong had not been preferred because it had been less friendly to things like dual share classes before. Overall, I don't think it's going to have that much of an impact on these markets. It's going to reduce the number of Americans who are buying, but as it is, there wasn't a lot of U.S. investment in China anyway. There's a lot more U.S. investment in the U.S., as you can just simply see by the trade balance. We really have to look overall at what are the other sources of investment into Chinese equities, of which, again, U.S. investors are a relatively small portion. Those pensions who are not barred from doing so, who still want to allocate to China, and especially those ETFs, if they're going to include China, they're going to include China. And whether it's listed in Hong Kong or Shanghai or New York, they're going to do so. And if there's an absolute ban where the U.S. is not allowed to invest in China, that may have a little bit more of an impact, but I think that's going to be more of a loss for the U.S. investor than it really will be for the Chinese market. Because again, there are lots of Japanese investors, Japanese pensions, not to mention European pensions, and not to mention a huge boom of domestic money, domestic pensions that need to be invested in those markets anyway. Long term, what I'm really looking at is I'm looking at businesses, and I believe that there are good businesses there that I can buy on one exchange or another. Thanks again for the question, and as mentioned, thank you again for attending. You should be getting the recording tomorrow, and I look forward to seeing you again on my next event.